Okay. And so you think about patience as a virtue. I actually don't believe that a lot of the time. I think that progress is a virtue and that once you're on the right path, then it's time to be patient.
Step into the world of success with your brand amplified, the ultimate podcast designed to unravel the intricacies of thriving businesses. I'm your host, Annika Jackson, and I'm on a mission to uncover the stories, strategies, and secrets that have propelled entrepreneurs and business leaders to success. It's always a good sign when I finally get to meet a guest. We have a really great pre-conversation and I say, no, stop there. Let's push record now. So I'm really thrilled to have Nic DeAngelo of Saint Investment Group with me today. Nic, we were just talking about the struggle of being an indie person, right? You may not have all the connections. You work your way up. For me, it's in podcasting. For you, it's now being president for over 10 years of your own investment group, helping others become successful and figure out how to make sense in this crazy world where, inflation and interest rates are up and down and we don't know what's going to happen next, how people can feel solid about what they're doing. So I'd love you to share a little bit about your journey, your story. You were telling me something really interesting when I stopped you and pushed record. So I want to dial back to that to get started.
Sure. Yeah, Annika, it's great to be here. I love your show, like I was telling you beforehand also, and the guests and the topics. Small business entrepreneurs, I love this category and your audience just, is great. So a little bit about my background. So I wanted to be in the investment world. I knew I wanted to be in the investment world. I was blessed to see people that were, relatively close degrees of separation away that had invested in real estate and found a lot of success. So I wanted to be near it. The problem was I had no skills and I had no money, right? I was young and broke. And those are two things in real estate that are very difficult to bridge the gap for. So my attempt to do it and my game plan was to find the best people locally that were still small enough where I could be close to that impact person, that decision maker, and kind of the leader of those organizations. The route that I found for me at the time, which is the post-2008 era, the whole world was falling in finance. Really, nobody even wanted to be in real estate. So in a weird way, it was kind of perfect timing. I approached, the CEO of a small family office, said, hey, I want to work for you. He basically laughed, right? And just said, no, we're just not hiring. And I said, no, you don't understand. I'll work for free. And I thought, in my early 20s stupor, or my, just not really understanding, I thought that was a huge chip, a negotiating chip, a positive chip. And he laughed again and said, kid, for free, I can't afford you. Right. And what that meant, and, it was a slap, right? I'm like, oh man, I just got, whacked by this guy. What it meant was the sky was falling for this individual. And he's somebody that I really respected and I understood what they were doing from afar. And the reality was it was all hands on deck. The market was crashing. They had a family portfolio. It was a small family office, multi-generational, and they were doing everything just to keep things afloat. So me saying, oh, I'll work for free meant to him, I was taking a ton of his time and that was not going to be interesting. That was not going to be an opportunity. So instead, I negotiated my way in by I put together a mailing list for people that were interested in buying apartment buildings at that time. And I just said, look, I understand that I'd be a drag on your time. And that's not what I want. I understand you have a tough situation where you're at. But if I give you this list of 500 people that want to buy apartment buildings in this market today, you can give this to your realtor branch, those that are doing transactions, and you could make some commissions. So not only will I work for free, which is a drag on your time, but you'll make money. And so he basically, it was probably 50% that I just annoyed him enough to kind of relent. But he said, look, I got a desk in the back. I'll see you Monday. I can't promise too much, just make yourself useful. And I leaned into that. So the next phase was I ended up working with several family offices along the way. I leaned into acquisitions, which is where I was finding off-market deals and opportunities. The big point came when we bought a deal that looked like a smoking opportunity. It was 50, 60% off market. But the issue was it was in a bad neighborhood. It was in a bad market. It was in bad conditions. And I followed their acquisition playbook at the time. And this deal almost tanked completely. So what I learned on the back end of that is that economics is extremely important. Innovation and improving systems and processes are extremely important. Staying ahead of technology and data is extremely important. So we've taken that ever since that day where things almost fell apart on a really big deal, and we've added it to the business since then. So that's a little bit about my early days. That's a little bit about my almost really bad experience that forced me, shook me to add new things to the process. And that's kind of where we're at today.
Yeah. Well, that's a lot in a very short time
Sure.
frame. So I appreciate the way that you share your journey. And I do have to say, a lot of successful people, it's because they persevered. The door got slammed in their face. They found a way that they could add value to the other party. I know people who've been executives at like MTV who did the same thing, right? They started out with what's the need that they have that I can help meet, or a need that they don't even know that they need, they don't even know that they have. And that's what you did. And that propelled you into this amazing journey that you've had.
It was a blessing. I stand absolutely on the shoulders of giants and mentors along the way. And it did take me being really annoying and setting my ego on the shelf, but it paid off. And these are people that are still dear friends today and dear mentors today.
Yeah. Fantastic. What did it take for you to go from working for these other organizations, using their playbook, to then going, I can do this a little better. I can do this differently. We need that innovation. We need to be up to date on the data, the analytics, the tech, and then start your own firm.
So it was partially because I had no short up position. I didn't have a formal position with the group. I had to earn my keep every day. I was kind of went out into the world because, in real estate, there's only so many departments. If you think about it, there's, raising money and financing deals. There's finding deals, the acquisition side, and then there's managing deals, the asset management side. So really there's big three. I thought I'd be a manager. Hey, I can help manage your assets. And they're like, we don't need somebody with no experience in a market crash to do that. But if you find us good deals, now we're talking, because not everybody can do that. So it was kind of like, the opposite of a sales position. I was out there. I had to go make it happen. I leaned into the data very heavily. I got taught, I was classically trained. So I had the benefit of starting where they left off, but I leaned into data more heavily. I found more coaches. I found more geeky data scientist type minds to teach me how to run property analytics and market analytics. And really, we were buying distressed assets, which means somebody wasn't paying somewhere. They were maybe missing their mortgage payments. We bought a lot of foreclosures. And that's what I did to innovate. I found properties in different ways than people before me for a couple groups. And at some point, it was a natural progression where we had bought enough assets, and basically, we had enough opportunities where we had inundated the property owners, those, small family offices. And they said, Nic, you understand the game plan from this. Like what you spoke to us about this. So why don't you lead the vision on this? I was in my mid-20s. So I was like, kind of shell shocked with that opportunity, but that naturally progressed. Eventually, we built out an asset management company. We built out an asset management team at Saint, and eventually evolved into raising our own money, working with our own investors, and just kind of swelling from there. So I think it's an iterative process. It's a constant process of seeing what the needs and opportunities are, leaning into those, innovating into those, finding what best practices you can improve upon and take into consideration. And we've really kind of done that at every stage, where now we handle all three. We buy our own assets, right? We raise our own money with our amazing investors. We manage our own, acquisitions process along the way, and our assets on the back end. So that's kind of, our journey to where we're at today. And now the story's scale. I've always been a growth-minded CEO. I've always, leaned into that, probably because I started with the mentality of needing to grow someone else's company. So now I'm in that role today. I get to help grow Saint and focus on the growth aspect. So I'm exactly where I should be with my personality.
Fantastic. So I want to talk about this. You have two foundational beliefs. Wall Street is broken. Amen to that. And real estate's the cure. And you're known as the fixed income GOAT in real estate. Talk to us about your process, and what does that mean to be the fixed income GOAT? And, there's a lot of questions there. So I'll start with that one, and then we can go to how is Wall Street broken? How do you see real estate as secure?
So I'm extremely partial to fixed income. And that's what that means, is that real estate historically is considered an asset class for growth. It's for appreciation. You buy a house or an apartment building or an industrial building, and then in X amount of years, it'll go up. It'll maybe double in value, right? That's kind of the standard game plan. And that's great. And there's absolutely opportunity there. The issue that we've seen along the way is that the market's very turbulent sometimes. And while real estate's usually more steady Eddie than other asset classes, nobody really that I saw carved out a niche leaning into fixed returns at a high level. So what we did when, I think it was, around the COVID era, right? The COVID era, early COVID, our investors were looking around saying, what the hell's going on? Nobody's paying their rents. There's a huge concern here. What asset classes are really poised for 10, 20, 30 years of consistent growth and consistency? And then also we saw that our most sophisticated investors, many of them were either in like a retirement planning phase or just kind of going into that. So they were very highly, sophisticated, wealthy, and wanted a long-term outlook just due to their age. So what we said was, well, what could we put together? Where could we be investing in the real estate world that has a niche that other people aren't filling? So what we found was the number one asset class that we absolutely find above all others at this stage of the market are single family mortgages. So homes, you walk through a neighborhood and there's white picket fences and families live there and they pay their mortgages. It's consistent. Mortgages in the United States are a unique investment. They're a unique tool because they're 30 years, 15, 30 years of fixed payments, meaning how much is being paid every month. And, they're owner occupied, blah, blah, blah. I could really brag about the asset class, but we found that as the number one most steady, consistent asset class during COVID, before COVID, thereafter. So we see that as an opportunity to buy and invest in mortgages and then pay returns to investors so that they can do whatever else. They want to invest in stocks. Okay, I'm not a stock guy right now for a lot of reasons that you kind of alluded to. I really love real estate, but timing's very important when you're buying, multifamily, like an apartment building, or you're buying anything else. Single family homes, residential real estate has consistently, and if you look at the fundamentals, it's the most consistent moving forward, I believe. So that's what we leaned into. That's what we talk about. That's what we give investors a lot of knowledge on pretty regularly with, podcasts or webinars, et cetera. So that's kind of the fixed income GOAT side.
Yeah. I love that because you're looking at the long run, which I think a lot of people don't. They want immediate gratification, right? And I also used to own some investment properties in Texas. I lived in Houston at the time and also in Kansas, which is where I'm from. And the stuff that I had that did best, and of course, I was the mortgage holder. I had renters, but there were a lot in the suburbs of Houston. I could get 2-story, 4-bedroom, 2-bath, beautiful houses, sometimes with a pool, white picket fence, good school district for 140, 160, maybe 200 something thousand. And the rent was amazing. And it was families who wanted to live there long term because they wanted to keep their kids, and they had young kids, right? Unfortunately, then I got divorced, and instead of asking if I could hold on to all the real estate, we dissolved everything. But that is 100% the place that I would go as well. So what does it take? What do you look for when you're thinking about the people that you will allow perhaps to invest in these opportunities?
Sure. And you hit on a really important point. So I'm just going to highlight something that you said. Single families it's an amazing asset class, but the number one issue so I own a couple homes. I own a few homes. Mm-hmm. The biggest issue with investing in homes is how scalable it is, right? Because you have one tenant, you got a bunch of toilets, you got middle of the night call. It's just hard to scale that. So we have, over 500 mortgages today. To own 500 homes, to manage 500 homes for all of our investors would be insane. We would lose our minds. But investing in the mortgage behind those homes gives us a lot of the same benefits, most of the same benefits, but 90% less of the headaches of the ongoing management. So it's interesting to consider, and we still have access to the same asset class. As far as what we do today and with our investors, we choose to work and really it's an SEC guideline for how we're structured. We work with accredited investors for a few reasons. One is it allows us to scale better. It allows us to work with investors at a certain level where they have a degree of sophistication and understanding about the marketplace. But, in the future, we've talked about opening it up to all investors and anybody who, would be interested or wants to learn more about the asset class. But today we have a minimum investment of $50,000 and we invest nationwide. So it's good. Lots of diversification. We find that the two groups that we find the most interested in our fund are entrepreneurs, so like small to mid-sized businesses, because they have cash flow ups and downs. So they might have their best Q4 and then they have a dry Q1, and they might know that that's a cyclical situation they got to deal with. So then if they just have a set return, they know that they are balancing cash flow. And then the other is for many of the same reasons, people that are moving to retirement or in retirement phase, balancing great net worths or, lots of financial sophistication. They just want a stream of income. So those are kind of the two of the bigger classes of individuals that we work with regularly on the investment side.
Yeah.
Which is great. I love working with sophisticated and smart people. So it's good.
Yeah. And for those who might not be as sophisticated in this area, you do a lot of webinars, you do a lot of speaking engagements, so that people can aspire to become that perfect investor.
Absolutely. And I'm huge on education. I'm huge on we want to give back as much as we can. But people say, well, hey, if we're not able to invest today, what do you recommend? And I'm like, invest in you, right? The next dollar is giving yourself the education to do that. Early on, I was dead broke. I was, scraping by. And every time I saved up, I was taking courses on investment strategy and managing data and how to dig into county records to figure out what the opportunities for foreclosing So I cannot support, and we don't sell a course or anything. I have nothing to even offer on that side other than free webinars and all that. But I'm telling you, investing in that side, boosting someone's income, very, very, very highly recommended.
Yeah. Fantastic. Well, let's talk about Wall Street. So
I could beat them up all day.
Yeah, no, bring it on, bring it on.
So first things first, I do, I hold a decent amount of stocks, but I don't buy any more today. And it's been a while. And the reason is, again, we're really heavy on the data. I geek out on it. It's probably like a weird, maybe I'm a little too weird on my economic interest, but if you look at the stock market since 1995, this is the scariest fact that I found. If you look at the stock market since 1995, the number of companies has been reduced by over 40%. Okay. So the total number of companies in the stock market has reduced by over 40% since 1995. The question is why? Because there's higher expectations for all kinds of compliance and it gets more costly, et cetera, et cetera. But there's another reason is that private equity, so private investments, private funds have disproportionately started buying small businesses or buying portions of small businesses where it's actually more advantageous for many small companies to not go public and to work with like venture capital or private equity in different structures.
Yeah.
So it's changed. The stock market used to be this opportunity where huge diversification, huge access to all kinds of the best, at one point, the best opportunities in America. Now that's not the case. Many of the best opportunities are private. So my concern is that when you look at things like, I forgot the exact statistic, I should know this, I just was looking this up yesterday, but something like the top 10 companies of this is loosely, the top 10 companies of the S&P 500 make up something like 50+% or 60% of the market cap, the total value of that exchange or that index. It's insane. It's overweighted. So it's no longer diversified. We now know that we're no longer getting access to the best opportunities in the stock market. They're now private, right? And then you look historically, you look at some big names, Steve Schwartzman, the CEO of Blackstone. He says basically if he's looking at an equity opportunity like stocks and then a real estate opportunity, he expects to get over 5% more on the real estate opportunity, which is roughly a 40 to 50% increase in returns. So all that to be said, again, I can beat up on Wall Street all day. There's great uses for it. But at this stage of the market, where inflation, imports, tariffs, all kinds of uncertainty and less diversification and overweighted in just a handful of companies, I don't see the game plan for the stock market being as compelling as it was previously.
Yeah, that makes a lot of sense. And then we also have all the different companies that people are investing in. And if 5 AI companies are doing the same exact thing and being overvalued, then, those aren't necessarily something you can buy as a stock because they are venture backed. But there's a lot there to unpack. And we probably could have conversations for days about this very topic.
Absolutely.
I do want to ask about real estate because just in the context of, we're both in California. I'm in Los Angeles on the other side from the fires, but we've seen so much displacement, people trying to figure out if they're moving, if they can even rebuild, how long it's going to take for all the toxic stuff to be out of the soil and the air so that they could possibly rebuild, trying to find new homes in a market where there isn't enough housing for everybody. So, obviously this is a difficult market. So I wanted to ask you just about the difficult markets. Do you stay away from them, or do you have real estate here and then you're seeing all this stuff happen? How do you course correct? Or what are the other things that you look for in various markets to make sure that it's going to be a solid investment for your investors?
So that's such a good question, especially with concerns like gigantic fires that destroy tens of thousands of acres, insane amounts of property damage. It really, the LA fires are heartbreaking. And it sounded, you and I talking before, it sounded like friends and family that were deeply impacted by that on your end. I have some as well. And I think it rocked Southern California in a big way. There's a lot of takeaways here. We can beat up on government, state, local, all the stuff that's beyond the scope of what we'll talk about today, right? But let's talk the asset class of single family homes, of residential homes, and how that's impacted. There's a lot of notes there. The first is that it's a tough market, and it's even tougher for people that are being displaced and they lost their homes in a situation like this. So let's just talk about base case. They lost their home and they had insurance, which is horrible, but not as bad as the alternative. In that case, these people have a tough situation. They're dealing with a market, as you know, Southern California, really nationwide, but especially Southern California and many of the highly desirable markets. We've seen mortgage costs increase by over 120%. Okay? Because you have interest rates that at one point were in the 2s, let's just say 3 for safe numbers, all the way up to the 7s, the low 7s. That is massive. That's brutal when you think about the impact of just paying money on the money that you're owing, or that, the debt that you take to purchase the house. Then we've seen this across the country. Property values go skyrocketing, going through the roof, with inflation particularly, which just blows up property values, makes them go crazy. So it's a tough situation for these individuals. Also, you're dealing with, God forbid they didn't have insurance, because you might have heard this in California or many other markets, Texas, even Florida really got hit. Insurance companies are pulling out of a lot of markets, and they're raising rates, 5x, 8x, just for the same insurance that the individual had, the family had the year before. So it's tough. It's really tough. The residential market, the question is, when's relief happen to the market? What's the future look like of residential? And the good news is we know actually a lot of what that could look like, or will likely look like. One, we know the inflation outlook is not good. Okay, it didn't matter if it was Biden or Trump. There's underlying situations that are driving inflation over the long term. It's consistently knocking the Federal Reserve off balance. But more importantly, for this conversation, we know something called construction starts. What that is permits and the process of people starting to build homes. Building real estate takes years. It takes 2 years, typically, plus or minus. But in the industry, we typically budget 2 years. We know that with building materials going through the roof on costs, and we know that with inflation and rates going very high, that there are not a lot of construction starts compared to what there could be. So relief on that side, it's not there, just to shoot straight. So the current market is extremely impacted. you have baby boomers that plan I think it's something like around 40%, plan to pass away in their homes. This is the last home they'll ever own, and they own a huge amount of the market. Many of them are at rates that are threes and fours. Why would they ever want to join the market at a 7% rate when they have a three or a four, right? And so many things are impacted. That's all the negatives in the residential market. The positives, which I always urge, especially on our webinars, is just where can you take a negative and make a positive? Because in the investment space, if one thing's bad, something's good. That's kind of how it works. Is there's an opportunity where there's chaos at the same time. That's one of the reasons that we invest in the mortgage side. We do it in a unique way. We get to kind of help families. We feel good about that. Our investors feel good about that. But also we can offer good returns because of how tight that market really is and how likely people are to stay in their homes and pay their bills. Because if they don't, the alternative is these very expensive situations of, double or triple payment costs on mortgages in the market. So there's goods, there's bads. It's kind of trying to navigate through that. But once and for all, it's most brutal for the families impacted by things like fires or, floods or anything that we've seen over the last year, these horrible, difficult situations.
Yeah. Yeah. Thank you for sharing that. You have a portfolio that ranges over 20 plus states, multiple projects. Like you said, 500 plus mortgages. You're on track to raise, is it 100 million annually towards investments? Are you also singularly focused on the United States? Are you looking at markets outside of the United States?
We've poked around just on the economics and the data. The truth is the U.S. is our focus because it's so head and shoulders above other parts of the world. Not to over drill down on things like geopolitics, but whether you look at NATO or NAFTA or G7 countries, all these different trade alliances or various alliances, the U.S. is such an economic standout in just with growth, with being rock solid financially, especially compared to all these other countries. I think people don't realize when we talk about, the U.S. this, and we're making these stupid decisions in Congress, and all those things are true, but everywhere else is so much worse off financially in the books and the structures that many other countries use. So we're very focused on the U.S. I beat up on the U.S. probably more than the average person, but I'm also more optimistic. And I actually believe there's more opportunity in the U.S. over the next decade than we've seen over the last 100 years, 100%. So I'm very, very positive on the U.S. right now over the long term.
Okay. Well, that is a very positive outlook and something for us all to think about. I have dual citizenship with Thailand. And so I've been looking at real estate over there. And you're right, it is very different. As a citizen, I can buy land. As a foreigner, though, you'd be able to buy the structure on the land, but not the land itself. It's a very different mortgage structure over there. And when you buy something, it's basically a 30-year lease, and then you can renew it at no additional cost. But that would be a complex market to find your way into. And I know that's, a far-fetched example, but it's one that I have at hand. So I see what you're saying. I also agree so much with the fact that there is nowhere for people to go. The baby boomers, they're priced out of their neighborhoods in many times. What I'm seeing in my own neighborhood is a lot of kids who are raised in these neighborhoods are now buying in. Once they get to a certain space, they're living across from their parents, right? Or a block away or a street away because they love the community. They want to come back. They finally have the financial means to come back and purchase and invest more in their neighborhood. So I'm interested to see when it begins to turn over a little more, perhaps, because we also read a lot about the younger generations not being so interested in owning. So what are your thoughts around that? Are you seeing some of that in your future projections?
Oh, yeah. That you hit on a lot of good points. One, the community building. What an amazing trend. We didn't see that for a long time. A lot of families spread out throughout the country and they'd move here and then job opportunities. So you move there. And we don't see that as much. The trend of people setting roots down and multi-generations on the same street, I think that's pretty amazing. And I think that goes back to maybe a few generations ago. So that's a powerful, interesting trend. The baby boomers being bunked in their houses. They are the wealthiest and largest generation that we have ever had in the United States, and relatively sophisticated financially. So they don't want to pay that extra money, right? But you asked a really powerful question, which is, well, when does it change? So the baby boomer generation during COVID hit a tipping point and they changed trajectory. The baby boomers were in the workplace. They, again, largest generation, most wealthy, kind of owned the workplace in a really big way for decades because of how freaking big of a generation. Gen X was stuck behind them, kind of a tougher environment for Gen X being behind such a huge generation. But then during COVID, it started switching and we went over the tipping point where now more boomers were in retirement than they were in the workplace. Ooh. So that was an interesting trend that shifted in the last handful of years. So then the next trend, now that more are in retirement and more are retiring every year, and they're actually shrinking generation, sadly, they're towards the latter third of their lives. You see the millennials are now technically by volume a larger generation than the boomers. That's interesting. Basically the children of the boomers. Where the boomers are at today and their impact on the residential home market is that we see them basically, statistically, most people are expecting they stay there through the rest of their lives, which if you want to, start ticking off averages, you're looking at a 15-year timeline before their loss is truly felt in the real estate market, the residential real estate market. So 15 to 20 years is the budget of really when that market really, really starts to turn over. There's also, in addition to the homes hitting the market, there's roughly $75 trillion in boomer net worth that's also trickling through the system as they pass.
Yeah.
So there are big economic trends coming down for the U.S. They're mostly positive. They're very primarily positive, but also a huge, massive tsunami of cash that's circling through the system from the baby boomer generation. So them passing along their homes, that's like really a 15, 20-year process as it seems now. The light at the end of the tunnel for new homeowners, for younger generations, for home ownership is really likely going to be leaning into construction, encouraging new construction, removing building issues and roadblocks in many, we're in Southern California. They will do anything not to develop new properties in Southern California, right? Even though we have density issues, traffic issues, all the issues. And so the path to progress is development. The path to progress is adding new homes and new living situations for new families and for new buyers. And if we get there, we consistently see in markets where they have less limitations that rents, that mortgages, that costs are much lower consistently.
Nice. So those are the things we should be looking for. I mean, I'm from Kansas. I know people who do a lot of investment in Ohio, and I've been hearing that market's getting a little saturated, because you can scoop things up for under $100,000 and rent them out. But yeah, I think I'm really excited to follow you and learn more about all of the stuff that I'm throwing at you. So I wanted to ask about your foundation, because I also see you've had a foundation for a few years, the DeAngelo Foundation. What is your mission? Why did you decide to start that as a give back?
I love it. So we have the benefit of working with a lot of high net worth individuals and a lot of investors. One of the amazing parts of that is that this crowd, this community is often very legacy focused and they're wealthy, right? So if you put those two things together, there's an opportunity to just like, hey, they don't want to go run a bunch of investments on their own. They're at the stage of life where they're not trying to add more to their plate. They're, often in their golden years. They don't want to freaking enjoy their life. And you know what? They earned it, right? So we're trying to do the same thing with the DeAngelo Foundation. The focus is on several things. They revolve around really investing in the country in a big way. The first is education. I'm huge on education and entrepreneurial education. Again, I'm so thankful for the people that gave me education firsthand, but it should be in the marketplace. It should be in the world. We give it away for free right now. Honestly, that's where we're at, is like, we're doing all the research. Let's just do webinars and just present it and put it together and organize it, not just for our investors, but for, the community at large, or just hopefully people will use the information, make good decisions, and improve the country. I mean, maybe that's maybe too big of a goal, but hopefully, right, is that people make smart decisions and improve the financial lives of Americans. The other side is, which we're leaning into today. I'd like to be further along than we are, but it's kind of a long process. It's identifying the biggest longevity factors that are holding people back. That if we solved X, it could add average of X or no average of Y to someone's life. So we're looking at things like cancer. We're looking at things like heart disease and the big opportunities there. So it's the early stages of the DeAngelo Foundation, but the interest is there. We're also looking at on the entrepreneur side, not just giving away all the information for free, but also there are amazing nonprofits that have literal free classes for people to go learn. And I think if you look at the AI world, and we keep talking, in the news, the buzzword is like, is AI taking jobs? Is AI taking jobs? The reality is, I believe AI will create more jobs than it will take away, but re-education is important.
Yes.
Getting people the education to be amazing in the next generation of business with the new technologies. I don't think we're prepared for that. And that's scary. So that's what we're looking at. Those realms, what the future is, improving lives, getting better education, extending lives through, different research we're kind of looking into now. So it's very early stages there, but we have a lot of interest from our, community on giving back and legacy and improving things. So that's what we look at. That's kind of what I geek out on, is the long-term perspective on everything and how the data supports one way or another.
Well, I definitely have some ideas for you that I'll share when we get off. I work in nonprofit, but to your point also about the reskilling, I teach for the Digital Media Master's program at USC. And one thing I'm constantly hammering is there is this new position. It's called an AI translator. And it's the person that translates from the C-suite who doesn't really understand AI to the data analysts and technicians to make sure that they're building out the right products for the company. So we need somebody who understands both sides and languages and can extrapolate them. There's also AI ethicists, right? But there is a huge need for the reskilling, upskilling, retooling people who are in similar industries to understand how to do this new thing, they've probably been doing, but maybe just need a little bit of a tweak. And then, of course, the opportunities that we're thinking about building, the investment that was announced with $500 billion in data processing centers. That's a huge need in the workforce too. That's going to create so many jobs, and we just don't have enough people. So I'm with you. I love studying AI, and it is going to create a lot more jobs. It's going to streamline the things, the minutia, right? But it's going to give us even more ability to live in that creative, strategic aspect of our human brains that only we can bring to the table.
100%. I think the net benefits are so much better than the risks and fears, really the over fear right now. So it's harnessing it, maximizing it. And if we can get people to lean into the AI space and the applications and the best use scenarios, wow, I'm so excited to hear that. I want a little insight about Annika and what you're doing with AI, especially with USC and all that. That sounds awesome. That's really interesting.
Thank you. So speaking of AI, are you using it in any part of your business right now? Is it helping you do some analysis?
We are. So we have two ways that we use it. One is more what you're asking, and then I'll give you the other one. The first is, so there's an investor named Ray Dalio, and he has been using AI models in investing for a very long time. He's kind of, he's been someone who's talked about it quite a bit. The problem is his failed, and they were very early generation AI, and they weren't beating the market. And the basic barometer for a lot of real estate and a lot of investment is, what is the S&P doing? What is the stock exchange doing in returns? Are you beating or not beating that if that's the kind of investor you are? And so he wasn't. But the takeaway was that it was not about only betting on AI. The takeaway was that you could apply AI to your current decisions and, check, and backstop and back check your decision making and your strategies so that you're making sure you're not missing something. And this is 20 years ago. So him not having AI under control was expected for that era, right? Like that's not so. Where we've seen AI grow in the investment space is with things like analytics, because for a while, investors would just, investors like my peers, a lot of times you just see a trend, you kind of do a trend line, and then it's just up and to the right forever. We know that that's not how the world works, okay? So we know that there's longer term trends. Sometimes there's 80-year trends for things like debt and finance, et cetera. Sometimes there's, commodity impacts from oil to, all the way down to the industrial sectors in the US. So now we're starting to see more complex decision making where something in Saudi Arabia actually legitimately affects the port of Long Beach, which then legitimately affects distribution throughout the Western United States. That is interesting. So this is where AI really, in the investment world for real estate, starts having major impacts. So investment decisions in real estate AI is being widely applied to investment decisions. We're starting to see trends on things that are further and further away from the central decision. And you start to be able to analyze things and, strength test and back test and, look through. So that's how we do that on the front end for acquisitions. We really can see market data. We can see how things like crime in an area might impact, future values, drawing correlations at a higher level. So yes, AI has been amazing for that. And it still has so much further to go. I think predictive AI in our space, I'm not 100% behind that. I'm extremely 1,000,000% behind the correlations that it's drawing and giving you a more full data picture of decisions. And I think it's nailed it already. I'll put it that way.
Oh, that's amazing. I'm just thinking about, of course, we have the tariffs that may or may not be happening. How's that going to affect the price of material goods coming over, lumber, other things that you need when you're doing house construction? There's so many things that I could see playing with AI models for. I could geek out on those.
It's really powerful. And the world is so interconnected and so complicated already that if you're not implementing AI in different ways to backtest different things, you're already going to miss a huge piece of the picture. So as much data and as much digestion of the data that you need support for that. And that's what AI comes in a big way. So it really is reshaping real estate and how we think about acquisitions, short-term and long-term.
Okay. Is there one other trend or thing people should be looking out for when they're thinking about making real estate investments right now?
The number one trend is going to be inflation, period. And I've been yelling this at the top of my lungs for, I don't know, probably 1.5 years, 2 years now. I've been saying this since Janet Yellen said inflation is transitory. And then a handful of months later, it was 9.1%, right? So the takeaways here, just to distill it, the trends behind inflation are here to stay for a longer period of time. Not to make any political statements, I think Trump and Biden both are pushing the right things, which are bringing industrial and manufacturing back to the U.S. I think the CHIPS Act had that focus. I think as much as the right versus the left wants to say how different they are, a lot of that's posturing, and they agree on things like hating China and manufacturing in the U.S. And, a lot of things get handed off from administration to administration and don't change. So they agree on some things, right? But bringing manufacturing back to the U.S., I think, is the biggest trend over the next decade. I think it's incredibly powerful for the future of our country. I think things like AI, that it's a trend we must get our arms around and we must own and be the world leader in. I think that's the biggest trend. All of those are inflationary, though. Okay. So even though that those are really powerful and they offer a lot of opportunity for the country in the future, it's inflationary. Building out a huge manufacturing base in the United States, inflationary. Tariffs, which on the negative make it more expensive for us as consumers. On the positive, maybe they add a little bit of space for homegrown manufacturers in the U.S. to make the goods with, a 25% tariff on whatever good and service. All that's inflationary. That's inflationary. So I would urge investors, I'd urge business owners or people, that are operating in a small to mid-sized company to consider the fact that inflation will be here for a longer period of time, most likely, to plan on it. I think real estate is absolutely an amazing hedge. If you look at history, it's one of the best investment hedges against inflation. So for individuals, I think it's amazing. For companies, I'd urge you to take a look at buying your building, especially if you're in the manufacturing space or in the industrial spaces, and putting investment into things that are real and tangible, I think is the biggest opportunity for the next decade plus.
Awesome. Thank you. And I always ask my guests Do you have a favorite quote, mantra, verse, words that help you get through every day, whether as a family, as a company, as an individual?
So I'll give you one of mine lately. And it's the phrase progress over patience. Okay. And so you think about patience as a virtue. I actually don't believe that a lot of the time. I think that progress is a virtue and that once you're on the right path, then it's time to be patient. Right. But I think the world's moving very quickly right now. And I think, just AI as a perfect example. If you're not implementing and testing many things right now in the fast-paced world that we're in, then being patient is a dangerous strategy. And I think it's things like either committing to being top tier at whatever you're doing or committing to working with people that are top tier at whatever you're doing. So lately we have been really leaning into progress and consistent progress and demonstrable progress over a period of time. And then once we have a good path that is on track, we've tested and we're confident in that, then we implement patience. So lately it's been that, progress over patience. We just want to see results and we want to see those consistently demonstrated. And then we look for a long-term trend. So that's just, we're in a growth phase for the company. So that's kind of something on this side that we've been kicking around a little bit. So it's a lesson that I think is counterintuitive for a lot of things, but I think it's powerful.
Yeah. Yeah, I would agree. It's actually something that I use in a different way with my students because I have a lot of students who aren't using AI yet, which is not what you hear in the media. Right. But I'm always like, no, you just have to learn. You have to dig in. You have to try out different tools. And you have to do it if you want a job in your field. Like there's no ifs, ands, or buts. We're going to lead people to saintinvestment.com to learn more, to maybe get a taste for your webinars. You have video resources. You have a lot of great information on your website. And this is really hopefully giving people a different perspective. Because I will say, I've had different real estate people on the show before, and you're approaching it from such a different angle that I think it'll really help people understand the why, the how, and figure out what they should be looking for in a future investment strategy. So thank you.
Yeah, I appreciate that. I mean, it's been great. I mean, even catching up before, great conversation here. And yeah, we give it all away for free. We spend many hours on the research. Like you said, saintinvestment.com/resources. We have long form webinars. We do them live. We answer live Q&A. We try to just give people the information that we're finding and let them make great decisions with it on the back end. But yeah, thank you for having me, Annika. I had a blast with you.
Yeah, likewise, Nick. Thank you to everybody who's watching this episode or listening to it on your favorite platform. Thank you to all of you who propelled this into the Apple marketing charts. I was so thrilled to see that. And we're going to keep that momentum going, right? Progress over patience, as Nick would say. And I'll be back again with another amazing guest to share some wisdom with you in the next few days. Thanks for listening or watching to this episode of Your Brand Amplified. Don't forget to leave us a rating or review on your favorite podcast listening platform. And if you want to learn more, check us out at yourbrandamplified.com.